The Roth IRA, you can take withdrawals that are qualified out tax-free. There's no RMD associated with it. They are super efficient when it comes to transferring to the next of generation. But are they actually tax-free? Well, in most cases, yes, but there are some things that you want to make sure of to make sure that your Roth truly is tax-free. That's the purpose of today's video, to make sure that any withdrawals that you take are tax-free and that you're getting the maximum usage out of your Roth IRA, specifically when it comes to a tax advantage standpoint. If we've not yet met, my name is Danny Cieniewicz. I'm a CFP professional with Hyperion Financial. If you're enjoying this video or you enjoy the content on this channel, please make sure to subscribe. You'll make sure that you're able to get the best information when it comes to taxes in retirement, along with retirement planning in general. And make sure that if you haven't yet, check out the quiz in the description below to make sure that your tax plan is on track. If you have a Roth IRA and you're planning to retire or you're already retired, you may have either used the Roth IRA or you're planning to use it. But I think there's a basic understanding that you need to have in order to make sure that you know if your Roth IRA is truly tax-free or not. Let's first start with how dollars get into a Roth IRA. There are three different ways in which dollars can be generated inside of a Roth IRA. The first way is that they can be contributed, and contributions are made with after-tax dollars. Generally speaking, there's a contribution limit that you can make from year to year, and you do need to have earned income in order to make this contribution directly. You're also subject to income limits as well. If you go over a certain income limit, you're not eligible to contribute directly to a Roth IRA. The second way that dollars can get into a Roth are converted dollars. And these generally come from pre-tax accounts. So for example, to get dollars into a Roth IRA, you can convert from a traditional IRA. And traditional IRAs are generally speaking pre-tax. They have not had any type of tax associated with them. So if you make contributions to a pre-tax IRA, you can in some cases get the tax deduction in the year that you make the contribution. But on the way out, those withdrawals are subject to ordinary income tax. But when it comes to a conversion, you can convert a part of that traditional IRA to a Roth IRA. And the benefit of doing a conversion is that there is no income limit that's required. There's also no conversion limit that's required either. You can convert as much as you would like in any given year. The downside is that when you make that conversion, again, it hits your ordinary income brackets. So if you do a Roth conversion, you're going to be subject to paying the ordinary income tax. And it could cause a number of other taxes to take place as well, such as net investment income tax. If you're in retirement, it could bump up your IRMA premiums. There are a number of different things that could end up causing you to have to pay other forms of tax if you do too much in one given year. So make sure that if you're planning to do a conversion, you understand how that works. One other quick thing worth noting is that some folks, higher income earners, take advantage of the backdoor Roth rule. The backdoor Roth IRA contribution is actually technically a conversion. So if you're familiar with that rule or you've tried to do that before, that's a conversion, not a contribution. The third way in which dollars can get into a Roth IRA are pretty much generated from inside the Roth IRA itself, and those are earned dollars. So just as you can with nearly any investment, if your dollars are earning interest or there are dividends that are reinvested or capital gains that are reinvested, those dollars that are associated with the earnings, they grow tax deferred. And I think when it comes down to these three different types of dollars that are generated inside an IRA, it's important to understand the distinction between the three because the tax treatment will have an effect in any one of the three of them. So with the IRS, they're going to look at how funds are actually taken out of a Roth IRA. How are they distributed? And they have a distinct order with how these distributions are taxed. So they follow in the order: number one, contributions; two, conversions; and three, earnings. So let's start with the easy one, contributions. Since they were made with after-tax dollars, these contributions can be taken out tax-free and penalty-free at any time. It doesn't matter if you're over or under the age of 59 and a half. It doesn't matter if your account has ballooned significantly or lost dollars. Contributions can be taken out tax-free and penalty-free at any time. When it comes to conversions, those are a little bit different. They have a 5-year rule in which if you're under the age of 59 and a half, the 5-year rule will apply. If you're over the age of 59 and a half, you don't have to worry about the converted dollar 59 and a half rule or the conversion rule because it will not apply to you. Simply put, the way that it works is if you complete a conversion and you're under the age of 59 and a half, you have to wait at least 5 years until after that conversion took place to access those dollars penalty-free. If you look to access those converted dollars in that 5-year period, you could be subject to a 10% penalty. Now, since you would pay the tax on the corresponding conversion in the year in which you do the conversion, they would come out tax-free per se. So you wouldn't have to worry about paying an additional tax on the converted dollars. It could just be subject to the penalty, again, if you do not satisfy that 5-year conversion rule. And then lastly, there are your earnings. And your earnings also follow a 5-year rule, but it's different than the one we just mentioned. The earnings rule and the 5-year rule that's associated with that actually has a little bit of a different nuance to it. So to make sure that an earnings distribution is a qualified withdrawal, you need to make sure of the following. Number one, that you're at least the age of 59 and a half. And number two, that you've had a Roth IRA open for at least 5 years. And why that's important is to make sure that if you've not had a Roth IRA open for 5 years, you could be subject to income taxes on the distribution, at least the earnings part of that. And with that said, again, it defeats the purpose if you're taking out a distribution and it's not a tax-free event of a Roth IRA in the first place. I think there are a couple misconceptions with this rule that I think sometimes can trip people up. Let's cover those right now. So the first one is that the 5-year rule applies to any Roth IRA that you would have funded. So for example, if you have 3 different Roth IRAs, which is allowed, you can do that. As long as one has been open for at least 5 years and has been properly funded, all 3 of those Roth IRAs have then satisfied the 5-year rule. So if you have one Roth IRA that's been open for a long period of time and again is properly funded, you want to open up a new one to specifically do a Roth conversion strategy, then you're in the clear. That 5-year rule has been satisfied. You do not have to worry about that, at least the earnings rule in this case. The clock doesn't reset if you open up any new Roth IRAs either. Again, that clock that is pretty much in place at any point. As long as you've had a Roth IRA open for 5 years, you've satisfied the earnings rule. The other thing that I think can trip people up, though, is that Roth 401ks and Roth IRAs are 2 separate vehicles or 2 separate examples here. So if you've had a Roth 401k for a number of years and you're planning to roll into a Roth IRA, you would not necessarily have this satisfied if you just open the Roth IRA in the given year. You need to make sure that you have a Roth IRA opened for 5 years and properly funded in order to satisfy that earnings rule. So make sure that you have this rule satisfied if you're planning to utilize these earnings and want to do so on a tax-free basis. The last thing to keep in mind, and this actually goes with both the conversion rule and the earnings rule, and something that I think can also help benefit people to make sure that the Roth IRA is properly done. When it comes to the conversion and the rule of the earnings rule, both of these have the same rule in that it starts in January 1st of when you actually completed either the conversion or the contribution with the earnings rule. So in other words, if you complete a conversion in December of 2025, as far as the IRS would be concerned, you completed that conversion on January 1st of 2025. So you don't need to wait until December of 2030 to have that 5-year rule satisfied. It's satisfied as of January 1 of 2030. It works in the same way when it comes to a Roth IRA for the earnings rule. Where the earnings rule can even go a step further is you can make a prior year contribution up until the tax deadline the following year. So a quick example would be that if I fund a Roth IRA in April of 2026 and it's prior to the tax deadline and it's a 2025 contribution, the IRS looks at the 5-year rule as if I had that account open since January 1st of 2025. Therefore, it's more of a 3 3/4 year rule if it's done in that amount of time. But again, making sure that you've done this in a proper way and you're working with a qualified professional is probably in your best interest to make sure that you're able to utilize these accounts tax-free. As discussed, I think there's no shortage of opportunities that a Roth IRA can present in retirement. It's not necessarily a one versus another traditional or Roth IRA that makes for the best strategy. It's usually some type of combination in between them, or in some cases, maybe it is one that could be better than another. But when it comes to Roth dollars, if you're taking distributions out when you're in a higher tax bracket than you would have been when you made the contributions, you've probably made out better. Roth IRA distributions can also be very helpful if you're near a certain bracket or a threshold when it comes to tax planning. If you need additional dollars from one of your accounts, a Roth IRA, assuming it's a qualified withdrawal, can generate tax-free income, therefore keeping ordinary income, capital gains income, net investment income, Social Security income, any one of these things that we're mentioning It can keep the tax on these benefits lower or non existent for some cases. Ultimately, though, when it comes time to your planning, having an income plan that's correlated with both your investment plan and your tax planning is one of the best things that you can make sure you're doing in retirement. A Roth IRA is one of the best tools that you can use, but using it improperly can also cause you to pay more in tax. One of the other benefits of the Roth IRA can be in regards to your Medicare premium planning. And when it comes to making sure that your IRMA surcharges are not causing you to experience positive jumps, and when it comes down to keeping your IRMA expenses low and not having to pay additional Medicare premium surcharges, Roth distributions can be very helpful. To understand how that works, check out this video right here to make sure that you are not having to pay any more in Medicare premium surcharges than you would be otherwise.